1 year ago, almost nobody was talking about Micron. The same thing happened with GE Vernova. Most investors were too distracted chasing flashy AI software stocks, meme rallies, and hype-driven headlines to notice. But behind the scenes, something much bigger was happening. The real money was not flowing into chatbots. It was flowing into the physical infrastructure powering artificial intelligence. And the investors who understood that early made absolutely life-changing gains. Today, that exact same pattern is forming again, quietly, under the surface, while the headlines stay fixated on NVIDIA and OpenAI. There are 3 companies right now solving the next great bottleneck in AI, and the smartest institutional money on Wall Street is already moving into them. Stay with me, because by the end of this video, you are going to understand a setup that most retail investors will not see until it is far too late. A quick note before we get into it. Nothing in this video is financial advice. I am not your financial advisor. I am an investor, sharing my own research and reasoning. These are high-growth, premium valuation companies, and I will be honest with you about the risks on each one. Do your own due diligence, understand your own risk tolerance, and make the decisions that fit your situation. With that out of the way, let us get into it. Let me start with the pattern, because once you see it, you cannot unsee it. Micron exploded because AI systems suddenly needed enormous amounts of high bandwidth memory. Every powerful model required faster and faster chips just to function, and NVIDIA's Blackwell systems pushed that demand into overdrive. Companies were desperate for memory supply. Micron stepped in at exactly the right moment, and almost overnight, it stopped being just another semiconductor company and became a gatekeeper. Demand got so intense, the company reportedly sold out production capacity years in advance. The stock entered a monster rally that shocked almost everyone. Then came GE Vernova. While the world obsessed over AI chips, a different crisis was building in the background. Power. AI data centers consume unbelievable amounts of electricity. We are not talking about normal server usage anymore. These next generation facilities need enough energy to power entire towns. Utilities and hyperscalers found themselves racing to lock up grid infrastructure before capacity disappeared, and GE Vernova's wind turbines and grid systems became critical overnight. Massive order backlogs formed. Utility giants started paying up front just to reserve manufacturing slots years ahead. Here is the lesson, and it is one that repeats through the entire history of technology. Every revolution creates bottlenecks, and bottlenecks create explosive stock winners. Railroads created steel empires. The internet created cloud giants. Smartphones created semiconductor kings. And now artificial intelligence is creating an entirely new class of infrastructure monopolies. The next winners may not be the companies building the AI software everyone talks about. The biggest gains may come from the companies supplying the invisible systems underneath everything: the connectivity, the networking, the cooling, the optical systems, the hardware itself. Today, I want to walk you through 3 companies doing exactly that. 3 companies that look eerily similar to Micron right before its breakout. The first company is Astera Labs, ticker ALAB, and most people have never even heard the name. But inside AI data centers, Astera is becoming extremely difficult to ignore. Here is why this matters. As AI systems get larger, data has to move faster between chips. It is no longer enough to simply own powerful GPUs. The real challenge is connecting thousands of GPUs together without slowing the entire system down. That is the new battlefield, data movement. If chips are the brains of AI, then connectivity is the nervous system. And Astera Labs is building that nervous system. They specialize in high-speed connectivity solutions that let AI hardware communicate efficiently inside massive server clusters. Without these systems, AI performance drops dramatically, which is exactly why the hyperscalers are paying such close attention. And the most recent earnings report is where this stops being a story and starts becoming hard, verifiable evidence. Astera just delivered record quarterly revenue of $308 million, up 93% year over. Gross margins came in north of 76%, which is an extraordinary level for a hardware company. Net income more than doubled, and the balance sheet holds roughly $1.2 billion in cash, with very little debt. That combination, explosive growth plus genuine financial stability, is exactly what serious investors look for. The company's Scorpio product line, its advanced fabric switches that help AI servers communicate at extreme speeds, is now becoming one of its most important growth engines. And this is happening right as the entire industry transitions toward faster networking standards, like PCIe Generation 6. As AI clusters scale toward hundreds of thousands of GPUs, every tiny delay matters. Even slight inefficiencies cost hyperscalers millions. Astera is positioned right in the center of that transition, and it is already pushing deeper into optical connectivity, which opens up an entirely new market on top of what it already dominates. The honest risk is that the stock trades at a premium valuation with high expectations, and customer concentration is real. A handful of customers each make up a meaningful chunk of revenue. But this is the nature of hypergrowth investing. The biggest winners almost always look expensive right before the next leg up. The second company is Credo Technology Group, ticker CRDO. And while Astera solves the speed problem, Credo is solving something arguably even more important as these systems scale: reliability. Here's the problem most investors have not grasped yet. The first phase of the AI boom was simple: build bigger chips, train larger models, scale faster. That created NVIDIA. But now the industry is hitting a wall nobody can ignore: stability. Once you scale an AI system to hundreds of thousands of GPUs operating together, the smallest networking failure can create a financial disaster. Imagine a hyperscaler spending billions building a massive AI cluster, only for tiny signal interruptions to slow everything to a crawl. Every second of downtime can cost millions. Credo positioned itself right at the center of that exact problem. The company is becoming a critical bridge between AI chips, servers, optical systems, and hyperscale networking, helping enormous AI systems communicate smoothly without breaking down. And the numbers Credo just put up are frankly some of the most explosive I have seen anywhere in this sector. Credo recently reported record revenue of $268 million, up more than 270% year over year, not 27%, over 270. Margins expanded aggressively and free cash flow surged. For the full fiscal year, management is guiding to more than 170% revenue growth. That kind of performance does not happen randomly. It usually signals the beginning of a much larger structural shift. For years, Credo was mainly known for active electrical cables, important but not exciting. Now everything is changing. As AI systems grow larger, optical networking becomes essential because optical moves data faster, more efficiently, and with lower signal degradation than copper. Credo saw that transition coming early and is aggressively expanding into optical transceivers and advanced photonic systems built specifically for next-generation AI data centers. One of its biggest upcoming technologies builds self-monitoring directly into the optical architecture, so the system constantly checks itself to prevent failures before they happen. Because hyperscalers do not just want speed anymore, they want predictability. They want stable uptime at enormous scale. The risk here is the same flavor as Astera: intense competition from much larger players and customer concentration that creates volatility if hyperscaler spending ever slows. But that is precisely why these opportunities become so explosive. When an industry transitions this fast, Wall Street struggles to price future demand accurately, and that creates real asymmetry. The third company is Celestica, ticker CLS. And this one is my favorite kind of setup, a business that the market completely wrote off, quietly transforming into something far more valuable while almost nobody was watching. At first glance, Celestica does not sound exciting at all. Historically, it was viewed as a low-margin electronics manufacturer, the kind of slow-growth, commodity-level business Wall Street usually ignores entirely. But over the last few years, something dramatic happened inside the company. Celestica reinvented itself, Instead of acting like a basic contract manufacturer, it aggressively pivoted into high-value AI infrastructure systems and original design manufacturing. In plain terms, the company stopped being just a builder and started becoming a designer of critical AI hardware architecture. That shift changed everything. Margins improved, revenue accelerated, demand exploded, and Wall Street finally started paying attention. And the most recent quarter is what turned that quiet transformation into a story the market can no longer ignore. Celestica delivered a blowout quarter, with revenue surging more than 50% year over year, earnings growth exploding, and operating margins reaching record levels, all while broader economic concerns weighed on the market. But the numbers are only part of it. The real story is underneath. AI infrastructure demand has become so intense that hyperscalers are now racing to secure future manufacturing capacity years ahead of time. We are talking about trillion-dollar companies signing binding, non-cancelable agreements just to guarantee access to future AI systems. That is not normal demand. That is something closer to panic buying. And Celestica is right in the middle of it. Its communications and cloud solutions division has become the engine of the entire company, as hyperscalers increasingly demand highly customized systems built specifically for AI workloads. Advanced Ethernet switches, liquid cooling architectures, high-speed networking platforms, and integrated system-level designs for next-generation GPU clusters. The company already has multiple active programs in the most advanced 1.6 terabit Ethernet systems, and it recently secured a major award tied to co-packaged optics, one of the next frontiers of AI infrastructure architecture. Those non-cancelable, multi-year customer commitments give Celestica a level of forward visibility most technology companies simply do not have. The risk, once again, is customer concentration. A handful of hyperscalers represent a large share of revenue, along with the potential for component shortages and margin fluctuation as competition evolves. But the direction of travel here is unmistakable.
Let me bring this all together because the thread connecting these three names is the entire point.
Most investors make the same mistake during every technological revolution. They chase the flashy companies everyone is talking about, the headlines, the hype, the viral excitement. But the real fortunes are often built somewhere much quieter, behind the scenes inside the supply chain. That is exactly what is happening right now in AI. While retail investors obsess over chatbots and software, institutional money is rotating deeper into the physical infrastructure layer, powering the entire system. Astera Labs is solving the data movement problem. Credo is solving the reliability problem. Celestica is solving the design, assembly, and cooling problem. 3 different bottlenecks, 3 companies becoming genuinely difficult to replace inside the systems they serve. And history is very clear on what tends to happen next once infrastructure companies become embedded into a technological revolution. Switching costs rise, customer dependency grows, margins expand, and Wall Street revalues the entire business upward, often faster than anyone expected. None of these are risk-free. They trade at premium valuations. They depend heavily on a small number of enormous customers. If AI capital spending ever slows unexpectedly, all 3 will feel it. I want to be honest about that. But artificial intelligence is no longer experimental. It is becoming foundational infrastructure for the global economy. And when an industry becomes foundational, the companies building the systems underneath it often become extraordinarily valuable. Micron and GE Vernova showed us the blueprint. The question worth sitting with is whether Astera Labs, Credo, and Celestica are now following that exact same path, and whether you would rather understand that before the crowd arrives or after. If you want to keep getting breakdowns like this on the companies quietly powering the biggest trends in the market, hit that subscribe button right now and turn on notifications so you do not miss a single video. And speaking of what is next, there is one more layer of this AI infrastructure story that I genuinely believe is the most overlooked of them all, sitting even further upstream than the 3 names we covered today. That deep dive is coming in the next video. Subscribe, and I will see you there.